Freeze. Don't scroll. Don't multitask. Don't let your brain drift for even 10 seconds, because what I'm about to lay out is not another update. It's a warning shot. If you've been feeling stressed, tired, or overwhelmed lately, take a breath right now. Because the people who should be stressed are not the ones holding silver. The people who should be stressed are the ones who think silver is still a small, sleepy market they can control with headlines and paper contracts. It's Tuesday, January 20th, 2026. And while the loudest Western outlets are busy arguing about the Fed, the latest political theater, or whatever scandal gets clicks today, something far more important is happening quietly in Asia. It's not trending. It's not being screamed from the rooftops. But it's moving money, moving supply, and moving the world. And here's the most uncomfortable truth. By the time the mainstream starts talking about it, it will already be too late to position cheaply. Now, quick support check, because I need you with me on this. My YouTube stats show a lot of you watch these videos, but many of you still haven't subscribed. If you value this kind of analysis, hit subscribe right now and leave a comment, even if it's just Arjon AG. That small action tells the algorithm this content matters, and it helps push back against copycat channels that recycle the same talking points without adding real insight. And if you want daily posts, quick updates, and my personal take the moment something shifts, plus instant voice notes I don't share on YouTube, I created a WhatsApp channel. The link is in the description. Join it, because the pace of this story is speeding up. Also, by the time you're watching this, there should be a members-only video already published with the complete set of updates in one place. If you want deeper, more detailed breakdowns and a tighter stream of premium analysis, consider joining membership and watching that members-only upload. It's also one of the clearest signals that you're actually following, not just passing through. All right, let's get into it. For months, we've talked about central banks. We've talked about big funds. We've talked about miners, industrial demand, and the usual suspects. But the market has a bigger force than any hedge fund, the savings of ordinary people when they lose faith. And right now, the largest pool of ordinary people savings on Earth is sitting on a pile so large it barely sounds real. Chinese households are holding roughly $22 trillion in bank deposits. $22 trillion. This is not some government sovereign fund. This is not corporate treasury cash. This is family money, retirement money. Money built over decades by people who worked, saved, and planned. And the reason it matters is simple, that money is getting squeezed, and squeezed money does not sit still. To understand the pressure, you have to understand what the Chinese saver believed for a generation. For years, the dominant belief was property is safety, property is status, property is the nest. People saved aggressively, not because they loved earning 1% in a bank, but because the final goal was a home, a second apartment, or an investment property. That was the ladder. But in 2026, that ladder is cracked. The property market has been hit hard. Confidence has been damaged by unfinished projects, developer failures, and price declines that break the old promise that real estate only goes up. When a belief system breaks, people don't calmly adjust their portfolio. They react emotionally. They seek refuge. So huge amounts of money moved into deposits. It's a natural human response. When trust is shaken, people choose the option that feels immediate and safe. But the bank option came with a hidden poison. Interest rates have been pushed down. Deposit yields are low. Some people are getting returns that feel like a joke compared to the cost of living. Now imagine the psychological nightmare this creates. You did everything right. You worked, you saved, you sacrificed, you skipped vacations, you kept cash for your family, and now your money sits in the bank earning almost nothing while prices for essentials keep rising. Whether inflation is officially reported high or low doesn't matter. What matters is the lived experience. Groceries cost more, energy costs more, transportation costs more, and the sense of security evaporates. So that $22 trillion isn't calm money, it's anxious money. It's money in search of an exit. But here's the trap. The exits are limited. Real estate is no longer trusted the way it used to be. Stocks feel dangerous to households that have seen sudden drops. Moving huge sums overseas is restricted. The government can tighten controls, banks can set rules, and the average person doesn't have access to the same offshore channels elites use. So people look for what is left. They look for assets that are liquid, culturally recognized, and physically real. And this is where silver becomes a problem for the system. Silver is tangible. It's divisible. It's accessible. It's historically trusted, and compared to gold, it feels within reach to the average saver. Gold can look intimidating when the price is already sky high. Silver looks like the underpriced doorway. Now, someone will say, okay, maybe some people buy silver. Is that really a big deal? Yes, it's a massive deal, because the silver market is small. Not small in importance, but small in size relative to global capital. The world produces roughly 800 million ounces of silver a year. That's the entire planet's annual output. Now, do the math with me. At $100 per ounce, that whole annual supply is about $80 billion of metal. 80 billion. Compare that to 22 trillion sitting in deposits. If you can't feel the imbalance there, you're not thinking in scale. If just 1% of that deposit mountain tries to move into silver, that's $220 billion of demand. That is not extra buying. That is multiple years of supply trying to get purchased in a short window. And markets do not handle that politely. Think of it like this. You can pour water through a wide pipe, and it flows smoothly. But if you try to push a fire hose worth of water through a straw, the straw doesn't gently widen. It bursts. That's what this is. This is why I keep telling you, the silver market doesn't need everyone to decide they love silver. It only needs a small fraction of a massive pool of money to decide they need protection. And when that happens, price does not drift upward. It lurches. Now, there's another layer to this that most people underestimate. When savers move into metal, they don't behave like traders. Traders flip. Savers hoard. A household that buys silver to protect purchasing power is not selling because the chart printed a red candle. They're buying because they don't trust paper. They're buying because they want something outside the system. That kind of demand is sticky. So why isn't this front page news every day? Because the moment the public understands a cheap, liquid hard asset is being accumulated, the rush begins. And the system hates a rush. Banks, brokers, and paper markets thrive when the public stays calm, stays passive, stays in managed products. Physical metals are the opposite. Physical metals are money you can hold, money you can remove from the fee machine, money you can keep outside the control grid. So a predictable pattern emerges. When metals start moving, mainstream narratives appear to discourage people. You'll hear that it's too late, or a bubble, or dangerous speculation. You'll see endless segments about why you should avoid it. You'll hear stories designed to make you question yourself. And this is why it matters that the pressure is coming from a place the Western media doesn't fully control, Chinese households. Because the story isn't being driven by one influencer or one fund, it's being driven by structural pressure on a population's savings, and that pressure is starting to show up in market behavior. Now, here comes a key signal, and this is where you need to pay attention. When authorities sense a price move that threatens stability, they don't always attack the fundamentals. They often attack the process. They change rules, they adjust requirements, they claim they're reducing volatility. They say it's for orderly markets. And we saw a move in that direction in Shanghai. There have been measures aimed at curbing certain forms of rapid, high-speed trading and exchange mechanics. The idea is to cool the tape, slow the momentum, and prevent runaway price spikes. In plain English, when the numbers start running away, they try to slow the scoreboard. But here's why that's so revealing. If a market is healthy and balanced, you don't need emergency rule tweaks to keep it stable. The fact that someone feels the need to intervene tells you the underlying pressure is real, and interventions have consequences. When you restrict fast liquidity providers, you thin out the order book. When the order book thins out, price moves jump. A buy order that once got filled smoothly now punches through levels. That creates gaps. That creates panic. And ironically, it can accelerate the very instability the authorities wanted to prevent. And this is the psychological aspect people miss. When a public sees authorities altering market plumbing, it doesn't calm them. It often alarms them. People read it as something is wrong. They read it as they're trying to contain it. And that can push even more money toward hard assets. Now, this is where the story splits into two realities, because you can look at paper charts and think you understand silver, or you can look at physical availability and premiums and understand what is actually happening. If you want the real picture, you don't just watch the screen price, you ask, what does it cost to get metal delivered? That's where the truth shows itself. And what we're seeing in parts of Asia is a classic two-tier market. The screen might suggest one price. The physical desk might demand a very different price. Dealers are not charities. They price risk. When inventory is scarce and restocking is uncertain, they add a premium. And when the premium becomes large and persistent, it's not a temporary markup. It's a signal that the paper price is no longer reflecting real scarcity. In simple terms, the paper market can print claims, the physical market cannot print bars. So physical sets the floor. And when physical owners decide they don't want to sell, the floor hardens. This is where the old concept becomes reality. The weaker money circulates, the stronger money disappears into hiding. People spend paper, they hoard metal. And hoarding in a tight market is like removing bricks from a wall. Eventually the wall doesn't just weaken, it collapses. Now, here's the part that should make you lean in. Even if you don't care about household demand, even if you think savers are slow to act, the industrial side can't wait. Industries don't get to hold and see. They need inputs, they need supply, they need metal on schedule, and silver is not a niche industrial input. It's essential. It's in electronics, connectors, medical components, and especially solar. And solar is the spotlight because the sector's demand is large, growing, and difficult to substitute away from quickly. So when silver pricing tightens, solar manufacturers face a brutal choice: pay up or slow down. And slowing down isn't just an economic decision. It can become a political problem, especially when production targets and employment are involved. So industry becomes an inelastic buyer. That means they keep buying even as the price rises. And when an inelastic buyer meets a tight market, price does not settle, it surges. We've seen signs of module pricing adjusting upward, reflecting cost pass-through. That is important because it tells you the chain is accepting higher silver costs. In other words, the industry is signaling, we will pay it, we have to. And as costs get passed on, consumers and projects absorb it. That prevents demand from collapsing immediately. That keeps the machine running. Now, if you're thinking, okay, but surely the market can find more silver, remember something critical. Most silver comes as a byproduct of other mining. You don't just flip a switch and double silver output because the price moved. New supply takes time. Permits take time. Projects take time. So when demand rises quickly, the only immediate adjustment mechanism is price. And price doesn't rise gently when the supply response is slow. It rises until it breaks someone. Now the next piece is the chart. The big money watches obsessively, the gold to silver ratio. This ratio is not a gimmick. It's a measure of relative valuation between the two monetary metals. When the ratio is very high, silver is cheap relative to gold. When it compresses, silver is catching up. Historically, the ratio has swung wildly depending on monetary regimes, stress cycles, and industrial demand. But what matters now is that if gold is already extremely strong and the ratio begins to compress, silver can accelerate faster than most people expect. Gold is the fortress. Silver is the lever. Gold can move, but it often moves with steadier steps. Silver is smaller, more volatile, and more sensitive to flows. So in a strong metals environment, silver can outperform. Now here's the math that makes people uncomfortable. If gold is at very high levels and the ratio moves toward more stress cycle levels, silver's price target rises dramatically. You don't need exotic forecasting models. You need division. If gold stays elevated and the ratio drops, silver rises. If gold rises further and the ratio drops, silver rises even more. That's why compressions can feel like the market snapping, because it's not one force. It's multiple forces converging. Household savings looking for safety. Industry buying to keep production alive. And the relative valuation gap closing. Now, I want you to think about something. What happens when the public realizes physical pricing is already far above the paper screen? What happens when the public realizes they can't get metal on demand? They don't calmly wait for a dip. They front-run availability. They buy before the shelves look empty. And that creates the run everyone is afraid of. This is where the psychological warfare begins. Because during the transition from a paper-led market to a physical-led market, you will see volatility designed to confuse you. You might see sharp drops on the screen. You might see sudden sell-offs on low volume. You might see experts telling you the move is over. And the purpose is simple. Shake loose supply. They want your metal. They want you to sell at the paper price so the system can relieve pressure. But if the structural drivers are still there, if the cash pile is still trapped, if the industrial bid is still inelastic, if supply cannot respond quickly, then those screen dips are not the end. They are opportunities. Now, I'm not telling you to do anything reckless. I'm telling you to understand the game. In a real tightening cycle, the screen price is often the last place to learn the truth. The truth is in delivery times. The truth is in premiums. The truth is in who is refusing to sell. And the truth is in the behavior of savers who no longer trust property, stocks, or bank yields. Now, before we wrap, I want to give you a creative detour that matters for mindset. If you want extra motivation, there's another channel linked in the description that focuses on silver-related success stories, how regular people positioned early stayed disciplined and benefited. Subscribe over there too if you want that kind of encouragement alongside this analysis. And again, if you've got a success story of your own, maybe you built a business, paid off debt, improved your life, share a quick line in the comments. It genuinely lifts others, and it also tells the algorithm this community is alive. All right, let's bring it home with clarity. We have a massive pool of trapped deposits. We have a broken property safety narrative. We have low yields punishing savers. We have limited exit paths due to controls and distrust. We have a small silver market that cannot absorb even a tiny fraction of a $22 trillion shift without repricing violently. We have market management behavior that suggests pressure. We have physical market signals that hint at tightness. We have industrial demand that doesn't blink. And we have the gold to silver ratio pointing toward compression dynamics that can turbocharge silver. Now, the big question is not, will it be volatile? Of course it will. The question is, do you understand why it's volatile? because volatility in this stage can be a symptom of stress, not a sign that the thesis is dead. In fact, the more pressure builds, the more dramatic the attempts to manage perception become. So don't let noise make you forget the core imbalance. And that brings me back to the most important practical point. By the time the average viewer hears there's a rush into silver, the rush has already happened. The first wave is always quiet. The second wave is chaotic. The third wave is regret. You want to be awake in the quiet wave. Now let me slow this down and make it even more concrete, because numbers like 22 trillion are so big that the human mind tries to reject them. It feels like a fantasy number. So let's translate it into reality. If you spread $22 trillion across 4 billion people, you're talking about an average of roughly $15,000 per person sitting in deposits. And that's an average, which means there are households with far less and households with far more. But even the average number matters, because when people feel threatened, they don't need to move their entire net worth. They only need to move the portion they can access quickly. And that's why the 1% thought experiment is so powerful. 1% is not extreme behavior. 1% is caution. 1% is a family saying, let's put a small slice somewhere safe, just in case. That's not mania, that's prudence. Now imagine the psychology of a saver who watched property promises fail. They don't need a YouTube channel to tell them what risk feels like. They lived it. They watched unfinished buildings stand like monuments to broken confidence. They watched friends get stuck in projects that never delivered. And once that kind of trust is damaged, it doesn't come back quickly. So they start looking for something else that feels final. Something that doesn't rely on someone else's promise. That's why hard assets always reemerge during trust crises, not because people become investors, because people become survivalists. And when millions of households start thinking like survivalists at the same time, small markets get crushed under the weight of that demand. Now here's where it gets spicy, and this is the part the mainstream will avoid discussing openly. When a population tries to protect itself, it often runs directly into policy barriers. Capital controls don't exist for decoration. They exist to keep money from leaving. So when deposits start looking restless, authorities have two broad choices. Option 1, raise interest rates and reward savers. Option 2, restrict movement and manage perception. Raising rates can hurt the debtors, hurt banks, and slow the economy. Restricting movement and managing perception is politically easier in the short run. So they manage, they guide, they stabilize, they create messaging, they adjust market rules, and the public senses it. You can't hide fear from a population forever. People notice the tone shift. They notice policy changes. They notice when the language becomes urgent. And the moment the public senses urgency, the instinct is to get ahead of the crowd. That's why this story can accelerate suddenly, not because of a single event, but because of a chain reaction of psychology. Now, let me address the counter-argument you will hear. You will hear someone say, but silver is industrial. It's not a monetary metal like gold. It's not the same. And I'm going to answer that with one sentence. That's exactly why it's dangerous. Because silver is both. Gold is mostly monetary. Silver is monetary and industrial, which means silver has two engines. It has the fear engine, where people buy it as a store of value, and it has the utility engine, where industries must buy it to function. So when fear demand and utility demand rise at the same time, the market doesn't have one pressure point. It has two. And that makes the repricing more violent. Now, another thing people ignore is how thin the investable silver is. Yes, the world produces hundreds of millions of ounces per year, but not all of that is available for investment. A huge chunk gets consumed. A huge chunk gets locked into supply chains. A huge chunk gets tied up in long-term contracts, industrial usage, and products that are not coming back to the market quickly. So the free float of silver that investors can actually buy and take delivery of is smaller than people think, which means flows matter more. Now, I want you to picture the exact scenario that keeps shorts awake. It's not that silver goes up 10%. It's not that silver has a nice year. It's the moment physical starts disappearing faster than paper can paper over. Because when physical disappears, paper markets face a credibility crisis. And credibility is the only real asset paper has. But once credibility breaks, paper claims turn into jokes. And this is why you see interventions. Because interventions are not about fairness. They're about credibility maintenance. Now, here's a cliffhanger you need to hold in your mind as we keep going. If the physical market in Asia is already showing a higher floor, what happens when Western buyers wake up and try to source the same bars? Where do those bars come from? Because they can't all come from mines. They can't all come from recycling. And they can't all come from inventories that don't exist. At some point, the market is forced to ration. And rationing happens through price. Now, there's another angle I want to add because it connects directly to household behavior. When deposits pay low yields, households look for alternatives. Some go to metals, some go to consumer goods, some go to anything that holds value. And when that behavior spreads, it becomes self-reinforcing. Because every time a saver sees prices rise, they feel punished for holding cash. That pushes them to move more money. So inflation becomes a psychological accelerant. It's not just an economic variable, it's a motivator. Now, let's talk about timing, because this is where people get sloppy. They want a calendar date. They want me to say, on this exact week, silver will explode. I can't do that. Nobody can, but I can tell you what pressure looks like before it breaks. Before a pressure cooker pops, you hear steam, you see small leaks, you see the lid trembling. Those are the early signals. Rule changes, premiums rising, delivery delays, industrial cost pass-through, a ratio beginning to compress. Those are the tremors. And when tremors show up together, you're not in a calm market. You're in a market approaching a phase shift. Now, let's circle back to Shanghai-style interventions for a moment, because this matters for the global narrative. When an exchange tries to cool things down, it often introduces measures like increased margin requirements, limits on rapid trading, or constraints on certain behaviors. And the public hears risk control and thinks it's normal. But you need to ask yourself a question. Why do they need more risk control now? Where was the urgency when prices were calm? The urgency appears when prices threaten to move beyond comfort. So interpret these moves as a sign of strain. Now, another cliffhanger. If the authorities are concerned about sudden spikes, what does that suggest about their view of available supply? Because if supply was plentiful, the market could absorb buying without explosive moves. Concern implies tightness. Tightness implies vulnerability. Vulnerability is what causes vertical moves when panic buying arrives. Now, I want to make sure we integrate something critical for community building. If you're one of the people who has benefited from staying disciplined, maybe you built savings, maybe you started a side business, maybe you positioned early in hard assets, drop a quick comment about it. You don't have to share exact numbers, just share the lesson. Because when people see others winning through discipline, they stop chasing nonsense and start building real foundations. All right, now let's zoom into the industrial side again and make it even more vivid. A solar manufacturer does not care about your chart patterns. A solar manufacturer cares about keeping assembly lines moving. If they don't have silver paste, they don't produce cells. If they don't produce cells, they miss deliveries. If they miss deliveries, they break contracts. Breaking contracts means penalties. Penalties mean financial stress. Financial stress means layoffs or closures. So when silver tightens, these manufacturers will bid aggressively. And the more they bid, the more they push price. And the more price rises, the more savers hear about it. And the more savers hear about it, the more they try to front run it. That loop is what creates the factory halt risk, not because the world runs out of silver completely, but because supply cannot be distributed fast enough at the old price. So the system rations through price spikes, and some factories temporarily slow because inputs become too expensive or too hard to source. And when factories slow, headlines appear. And when headlines appear, more savers panic. And when savers panic, more money tries to move into the metal. That is how feedback loops form. Now, let's talk about the gold to silver ratio in more detail, because I want you to understand how powerful the compression can be. For decades, people have watched the ratio as a mean reversion tool. When it's high, silver is cheap relative to gold. When it's low, silver is expensive relative to gold. But in stress cycles, ratios can move into extreme territory, and silver can overshoot, meaning silver doesn't just catch up, it can temporarily run ahead. This happens because silver's market is smaller and more volatile. So once momentum begins, it can accelerate beyond what seems rational, until it becomes the new rational. That's why people who only look at silver in a calm environment get shocked in a hot environment. They think, silver can't do that. Then it does. Now let's do a few scenario numbers, not as prediction, but as a framework. Suppose gold holds around the mid-4000s and the ratio moves toward 50. That alone implies triple-digit silver. Suppose gold moves higher and the ratio compresses toward 40. That implies even higher silver. Suppose gold moves higher and the ratio compresses toward 30, which has happened in major metal phases. That implies silver levels that sound unbelievable today. And if we see a real stress environment where the ratio compresses toward 20, which historically appears in extreme monetary moments, then silver targets become explosive. That's not hype, that's math. Now, the reason I'm emphasizing this is because it connects back to the household deposits. A saver doesn't need to understand the ratio. They only need to feel gold is too expensive, and silver is still affordable. That's enough. That's the trigger. So silver becomes the mass market refuge. Gold becomes the premium refuge. And mass market flows in a small market create violent repricing. Now, imagine a Western buyer looking at their screen price and thinking they can wait for a pullback. Meanwhile, the East is paying up for physical. That's how you wake up one day and discover the pullback didn't arrive, but the availability did. Now, I promised you this would be aggressive, viral, and retention heavy, so here's another cliffhanger that you should hold until the end. If the deposit mountain begins to move, the first visible sign might not be a price spike. It might be a shortage. It might be a sudden increase in delivery times. It might be dealers saying 2 weeks, then 4 weeks, then no quote, because the system can delay the message in price, but it cannot delay the message in delivery forever. Now, let's talk about perception management one more time. When authorities or large institutions want to slow a rush, they usually deploy a few tools. They talk down the asset, they highlight risks, they raise costs like margins, they flood the narrative with reasons you should hesitate, and they try to create sudden dips. These dips do two things. They scare weak hands into selling, and they discourage new buyers from entering. That temporarily relieves pressure, but it doesn't solve the underlying imbalance. It only buys time, and time is what a stressed system wants. Now, I want to integrate a quick viewer question moment, because it mirrors what we do here and it makes the analysis practical. A viewer recently asked, if the authorities can control markets, why would silver ever break free? And the answer is, control works best when the public is calm. Control works best when demand is optional. But when demand becomes necessity, industrial necessity and household necessity, control becomes harder, because you can manipulate paper claims, but you can't print physical bars. And you can't tell a factory to stop needing inputs. And you can't tell a household to stop protecting itself when trust is broken. So manipulation can slow, it can shake, it can confuse, but it cannot permanently override scarcity under sustained demand. Now, another viewer asked, what should I watch day to day? And I'll give you the practical list. Watch premiums, watch delivery times, watch announcements of rule changes, watch industrial pricing pass through, watch the ratio trend, and watch how quickly narratives shift from ignore it to it's a bubble to it's dangerous. Narratives only get loud when the move matters. Now, I'm going to re-mention something important, and I'm doing it on purpose. If you want these updates without waiting for the next YouTube upload, join the WhatsApp channel in the description. That's where I can drop quick notes, instant updates, and voice messages when the situation changes suddenly. And if you want the full in-depth bundle, check the members-only video that should already be live. The premium breakdowns are where we can go deeper without cutting corners. All right, let's set the final trap on the table because I don't want anyone saying later, I didn't see this coming. When silver starts moving, people will try to talk you out of it using two tactics. Tactic 1, they'll say it's overbought and you missed it. Tactic 2, they'll engineer volatility that makes you feel like you're wrong. Both tactics are designed to do the same thing, get you to hand over your metal before the bigger wave arrives. But the bigger wave is not a rumor, it's the deposit mountain. It's the cash pile trapped behind low yields and broken confidence. And even if the mountain moves slowly, the silver market is so small that a slow move can still overwhelm it. That's the paradox. Now I want to give you one more mental model. Imagine you're standing in a theater and someone yells, fire. At first, a few people move, then more people move, then everyone moves. The door didn't change, the hallway didn't change, the exit didn't change, but the pressure changed because behavior changed. That is what happens in a rush to safety. The asset doesn't need to change. The perception changes, the urgency changes, and suddenly the same market that looked quiet becomes a stampede. Silver is that door, and a $22 trillion pool of cash is a lot of people in the theater. Now, in the next video, we're going to go even deeper into what could trigger the next phase. Whether it's another property shock, a policy shift, an industrial squeeze, or a sudden premium blowout that makes headlines impossible to ignore. But for now, you have the core framework, and the core framework is enough to keep you positioned while others are still debating. So let me end with focus. If you appreciate this content, subscribe and comment Our John AG. It supports the push against copycat recycling, it strengthens the community, and it tells the algorithm you want more of this. Join the WhatsApp channel for daily updates and instant voice notes. Watch the members-only video for the premium bundle. And remember, if you're successful, share a quick line in the comments. Your story might be the reason someone else stays disciplined. Now answer me honestly. If that $22 trillion deposit pile starts shifting even slightly, do you think the market will give you time to wait for the perfect dip? Or do you think the world only realizes what silver is worth when the shelves are already bare? Drop your thoughts below.